Fallout from the war in Iran are pushing higher the odds for a rate hike. Those odds now a 42% probability of a hike as soon as October, compared to yesterday's odds of just 19%. Our next guest says what ultimately matters to the economy is how long the shock to the economy will last. Joining us now is Torsten Slok. He's chief economist at Apollo Global Management. It's good to see you, Torsten.
Thanks, Michael.
This seems to be the issue, right? I mean, are we just going to have to kind of absorb a quick shock? Or is it going to be something that the market is going to have to deal with for a while? So what's your base case on that?
Well, what's really remarkable is that the conversations we had like a month ago was all about AI, rates are going down, the Fed will have to cut, the unemployment rate is going up, We're all becoming unemployed. And now we suddenly have a distribution of outcomes where the market is pricing that we may have a higher likelihood of a hike. It is truly unusual. But it is, of course, because the market putting weight on higher oil prices. We also have some upward pressure on inflation from tariffs. We also have some upward pressure on inflation coming from generally the economy still doing remarkably well. So the Fed is in this difficult spot where on the one hand, yes, the economy is doing well, and adding on top of that an oil price shock. And on the other hand, we still have the AI discussions, which we'll surely come back to discuss for, again, the very, very long period of time. So that conversation at the moment is just telling you that there is now also some worries about that maybe the Fed will have to hike. I still think that's extremely unlikely, mainly because Kevin Walsh will not come in as the first thing and hike rates. And also the economy, if anything, when we have had an oil price shock, it comes with a risk of demand destruction and ultimately, therefore, a slowdown in growth.
How do you see, if at all, European inflation impacting what we're seeing here in terms of their mandate to fight inflation, first and foremost, their only mandate, in fact, the ECB, to fight inflation, and then just the contagion, if you can call it that, in terms of slowing growth there and how it might impact us? Yeah,
this is very important, Melissa, because the ECB, exactly as you're saying, has one goal and one goal only, namely inflation needs to be 2%. The Fed has two goals. Inflation needs to be 2%, and we need to have full employment. So that's why that gives more flexibility to the Federal Reserve in terms of thinking about how much weight should we put on inflation, how much weight should we put on the employment mandate. And at the moment, it's clear inflation is higher, employment is still holding up, but there are indeed some downside risks, as Michael also was just suggesting, to the issue that we might begin to see growth slow down if this shock persists for a longer period of time. So that's why it's in some sense easier to be the ECB and the Europeans, because they only have one thing they need to solve for. But the challenge for them is that now that inflation is under upward pressure, markets are beginning to price ECB hikes. And that's just really unusual. The ECB should not be raising interest rates if the European economy is going to slow down. So there's some real headaches and challenges in Frankfurt coming with this shock, namely how do you deal with this risk that inflation is going to go up while the European economy is slowing at the same time.
You characterize the U.S. economy as doing remarkably well. I guess what are we looking at to make that conclusion? Just because there is a camp that says, look, the unemployment rate is, a percentage point above its lows. You've had very weak job growth for a few months here. Housing market is not an engine of growth, all the rest.
No, fair enough. If you look at the incoming data while the Iran conflict has been going on, if you look at the daily data of how many people fly on airplanes, despite the challenges in airports at the moment, the TSA passenger throughput, meaning how many people scan their boarding pass at airports, is actually the best it's ever been at this time in history. In other words, more people are flying on airplanes at the moment than we've had at any point in time at this date in March going back in the last 20 years. So therefore, airline traffic is still very strong despite higher prices, despite higher jet fuel. Everything is still remarkably well on that front. The weekly data for same-store retail sales from Redbook, which is data that comes out every Tuesday, it tells you what was consumption last week, is also still very strong. And finally, we also have for hotel demand, RevPAR is very strong, occupancy rates are very strong, and the daily rate, meaning what people pay, is also very strong. So you're right. If this shock does continue, then, of course, the demand destruction could ultimately mean that these things could begin to slow down. But at this point, with the tailwinds coming from AI spending, the One Big Beautiful Bill, all those things still suggest that if this is going to just be only for, again, a few more weeks, this may end up being an investment where we had some volatility, but on the other side, we may have a much more stable future where we no longer have this geopolitical risk that we're facing at the moment.
It's interesting, though, because everybody we've had on said a few weeks ago if it lasts for a few more weeks, and now a few more weeks here, and then there's a few more weeks.
But obviously, a war is very complicated in terms of what are your choices, what are they doing, and at this point, yes, there is a lot of different things that we need to realize. But let's just agree as we get closer to the midterm election and as we get closer to the summer, all considerations about munition stocks and other things, we will probably begin to see some more into at least the fighting, at least over the next several months, even if it's not the next several weeks, as you're saying.
Yeah.